The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
Before we get started with our Strategy Spotlight segment with Alex Jacobson of Options Xpress, let's talk a little bit about this important year in the options industry, 40th anniversary for the options business. It was almost exactly 40 years ago today, April 26th, 1973, that the listed options industry began on the Chicago Board Options Exchange. That day in April, the industry started with 16 underlyings, all calls, no puts, if you can possibly believe that. I'm not sure how many of our listeners do realize that the first 4 years in this industry, the underlyings only traded calls, no puts. I still find that hard to believe. But 40 years ago, as I say, almost to the day, was the start of this industry. And the last thing I'd like to say about this anniversary is maybe take us back a little bit in time and tell everybody the 16 original stocks that traded that first day. AT&T, Atlantic Richfield, Eastman Kodak, Brunswick, Ford, McDonald's, Lowe's, Gulf and Western, Syntex, Merck, Northwest Airlines, Pennzoil, Upjohn, Polaroid, Texas Instruments, and Xerox. Some great names, many still around. A total of 911 contracts traded on that first day. It's a little bit of a look forward in terms of this being our 40th anniversary year, and also a look back with the 16 underlyings that started the options business in April of '73.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining me today on Strategy Spotlight is Alex Jacobson from Options Xpress. Alex, great to have you on the show today. Thanks for joining us.
Hey, it's a pleasure to be here.
I know you've been plugging away on the education side specifically for a long time, Alex. Tell us a little bit about what you're doing now and some of your most recent experiences.
Well, my experience goes back over 40 years. I mean, I have actually been in the business so long that the first class I ever taught was a warrants class prior to the listed options market. And then in the early 70s, I was coming out of college and was a charter member over at CME at the International Monetary Market. I had ambitions of being a floor trader, and I had the good fortune of literally coming out of college just as the listed financial derivative markets in Chicago were getting their start. And I kind of joke about this a lot. I went to the University of Illinois Chicago campus, which was then called the Chicago Circle campus. Cost about $800 a year to go to school if you were an in-state resident, and all my finance professors were PhD candidates at the University of Chicago. I mean, literally, I had the opportunity to learn from the people who were creating the new marketplace. So I got $1 million education for about $800 a year, and
spectacular.
Yeah, while I was in college, I started as a runner on the floor of the old Chicago Mercantile Exchange, which is now the train station and the health club. And
it's still got a lot of character.
Yeah. I mean, there's so much great history in Chicago. One day if we ever get a chance, we should, do a show on history and how these markets evolved. But,
Let's do that.
Yeah,
that'll
such
be
a
down
great
the road
business.
a bit.
But so I began trading options and futures as soon as they came out. In 1980, I went to work at Merrill Lynch on the customer side, the high net worth division, and was there for a few years. And then in the early 80s, I was going through a life change, career change, had some resumes out on the street, and I got a call from the CBOE. And the CBOE was looking to start a school. In fact, today what's called the Options Institute.
Sure.
And on my resume, I had taught inside the Merrill Lynch training system, and they were looking for that kind of experience, and they kind of weren't sure what they were going to do with education, but the plan was to train as many brokers as they could. Back then, the business was dominated by what we refer to as kind of the full-service wirehouses, the Merrill Lynch's, the Morgan Stanleys, the Smith Barneys, and CBOE had this plan that basically said if we train 100 brokers, they each train 100 customers, and that's how they grow the business. So
that was the focus there.
Yeah, that was the focus. It was a pilot program. I was actually started on a daily rate, and the Shearson Training School had actually been located in the CBOE. They had just moved out to get expanded space. So the CBOE devoted the space where they had been and created this pilot called the Options Institute. And I was hired as a consultant, and I was given a day rate, and we looked at...
And the rest is history.
Yeah. And now it's an industry resource, and the Institute has now been around for since the early 80s, so
yes.
Going on 30 years, and trains thousands of people and does great stuff. So I was at CBOE for about 2 decades, and then in 2000 I was recruited away to go to the ISE and essentially do the same thing. And I for years went literally around the world and trained everybody from investors to hedge funds to mutual funds to state pension plans, and it was great. And in a couple of years back, I was kind of tired of traveling 200 days a year and decided to slow down a little bit. Lived in Chicago my whole life. Had friends here who had started this company, good friends, and they were big supporters of options trading. I mean, it's in the DNA here. And they said, come to work for us. And take what you've learned over the years with institutions and active traders, and let's try to develop products that do those same things. So that's what I do now, and it's a lot of fun. And we've come out with some award-winning products. In fact, just a couple of weeks ago when the Barron ratings came out, one of the products we created for customers, essentially our Ideas Hub, our premium harvesting product, won an award, and we're very excited about that.
Well, fun is good. And after all these years, to still be enjoying it speaks to your passion for the industry.
Yeah, thank you. As I tell my kids, I've never worked a day in my life, and they look at me and they go, "Yeah, you weren't home a lot, though."
Well, Alex, your years of experience, it was interesting. When I reached out to you, you said you wanted to talk about credit spreads. Why don't you start by defining credit spreads? And, of course, we'll go from there and get into the risk-reward aspect as well.
Cool. So a big portion of the community that uses the options market, in fact, here in the kind of e-commerce discount community, about half the business that's done is market-neutral kind of premium harvesting strategies. And that encompasses lots of strategies, but for a moment, let's focus on credit spread trading. The concept behind credit spread trading is I want to sell some premium because I think an index or a stock or an ETF is going to stay in a given range. And statistically, what implied volatility does, if you look at the implied volatility, essentially it's describing what the marketplace thinks will be a plus or minus 1 standard deviation move over a defined period of time. It can be 1 day, 1 week, 1 year. And what the industry does now is it calculates a number of volatility benchmarks, and I'm sure your listeners are familiar with these. But what you could do is take those volatility benchmarks. Let me do a hypothetical example. Let's say you had an index trading at a value of 1,000.
Okay.
And let's say its implied volatility was 16%. And obviously I'm making this, black and white, so it's easy to kind of get your arms around. So if an index were trading at 1,000 with a 16% volatility, that would mean that the marketplace's current consensus view is that 1 year from now, about 70% of the time, it should be plus or minus 16%. So roughly 840. It's not exactly 840 because it's 16% of the move up, but 1160 on the upside, and call it the mid 800s on the downside. Now I can take that implied volatility number and turn it into a 1-day estimate, a 2-day estimate, a 30-day estimate, 60, 90, whatever the investor is comfortable with. And in fact, a lot of investors in the last few months have been real comfortable with weeklies.
But let me ask you, how does an investor, find out that daily, weekly, and monthly number?
Okay, well, one of the easiest ways to do it is the exchanges calculate that data. The brokerage houses calculate that data. You can essentially go to your brokerage platform and look at the volatility of the at-the-money put-call pair, and then it's fairly easy to translate that. All volatilities are normally expressed as an annualized number. Right. So let's say you're looking at a technology index or a technology ETF or something that's maybe a little more volatile than the S&P, go to your option chains, look at the implied volatility of the at-the-money pair, and let's say it comes back, and again, I'll make this black and white, it comes back as a 40% implied with the at-the-money put-call pair. Well, the way normalizing it down to 1 day, 1 week, it's essentially the square root of the change in time. So a 1 day estimate There's 256 trading days in the year, roughly. So one-day estimate for our 40% volatility instrument would be 40 over the square root of 256, which is 16, which gives us a number of around 2.5. So I would know that the consensus for the market is that technology index should stay within about a 2.5% daily range, about 2/3 of the time, plus or minus one standard deviation. And
you used 256 trading days, not days in the year. So that's the math behind it. Yes?
Yeah, and that's a question that comes up a lot. It's actually a great question, Joe. Volatility looks at trading days, and it might not be a perfect 256 trading day year, but volatility uses trading days, and we in the options industry frequently like to quote the 256 number because it squares nicely down to the one-day number. I know some of your listeners are going to scratch their head and say it's really a 259 trading day year, or depending on when the holidays and weekends fall. But the 256 is not a bad benchmark. But I can take a volatility number, which again is always expressed on an annualized basis, and turn it into a 1 day or 1 week. Here we have a lot of people who like the 1 week because of the success and the good liquidity in the weeklies. And then I can identify the spread I want to sell by taking that volatility number, creating the 1 week range, again, on our $1,000 index. The 1 week number might mean we've got to be 40 points out of the money on each side. So that if you were a premium harvester, you'd sell the 960, 950 put spread. That's a $10 white spread. The 1040, 1050 call spread. There's your iron condor. Let's, again, black and white. Let's say for that weekly I could take in $1. You look at the term that we use is return on risk, which means if I can harvest $1 in premium on a spread that's got $10 in risk, my return on risk for that week is 10% if the market, our index, stays above 960 and below 1040. And that's a big part of the appetite in the options market. In my travels over the years, it didn't make a difference if there were institutional customers or if they were endowments or if they were just simply active investors. There's a huge appetite to use the options market for some form of premium harvesting or regular ongoing effort to earn premium income.
Well, I think what you just described is actually one of the most important, well, it's one of the most challenging aspects, and also I think one of the most important aspects. You offered a specific recipe for investors how to target a strike price. And so often when we're out there on the road, we get the question, and investors are looking for a black and white answer: what strike, what month? And I think what you just described, albeit a little bit of math, is really a wonderful approach to helping investors either, in an index or an individual option, pick a strike price. And one other thing that, maybe you're implying, but talk a little bit about this idea of the spread aspect as opposed to just, harvesting premium through naked options, because I think, the spread aspect speaks to the risk management component, and there's nothing more vital.
Yeah, and that's one thing we learned as an industry, and the investor community learned. If you go back into the 80s, the big strategy at the SIBO, this is back in the days when the OEX, the S&P 100, traded, a million contracts a day. And what you saw as investors had sort of a pre-programmed plan that said, look, if the OEX is, again, I'm just going to make up a number. The OEX is 1,000. I want to sell a put 10% out of the money and a call 10% out of the money. And, I have a good sense that that'll make me money, 70, 75% of the time, maybe even 80% of the time. But what's not in that equation is what's the pain when you're wrong. And as I say, prior to the experience of the market break in 87, 89, and other market events we've had since then, the financial meltdown in 2007, 2008, in the early days, people just sold premium, looked at the numbers and said, look, I got a 90% probability of making money. And we in the options industry would say, what about the other 10%? And they'd say, well, don't worry about the 10%. And now we worry about the 10%. So we manage risk. So instead of selling pure uncovered naked premium, some investors will look at $10 wide spreads. Again, it depends on the instrument,
and the listener's appetite for risk.
Yeah, and there are a number of factors that come into these. One of the issues, I get the same questions you get. What strike? How long? There was a time, I remember once I was giving a class, and a customer got up and said, I like to say, sell based on deltas. So I want to sell things that are, no higher than a certain delta. Everybody can get to their comfort level, but one message that resonates is you got to manage risk. And to your point, some people are willing to do $10 spreads. Some people, maybe on a higher priced instrument, might want to do a $20 spread. It's kind of where their comfort level resides. A lot of people do this on stocks, and they're going to have to do it $2.50 wide or $5 wide, depending on the strikes. On the higher price stocks, obviously lately there's a lot of high-priced liquidity in the market in kind of the household names. And, there you might want to go $30 or $40 wide, depending on your risk tolerance. The interesting thing is we're in an environment where implied volatility, at least lately, has vastly exceeded realized volatility, which means these kind of premium harvesting trades have worked well, but it also means, for what it's worth, that option volume hasn't been great. And one of the reasons option volume hasn't been great is a lot of this trading has worked. It hasn't need to be adjusted or rolled up or rolled down. It's people who put these trades on and have the good fortune of not having a market move, and they hold on to expiration. One of the things I've learned over the years is when you have environments where implied volatility is higher than realized volatility.
And that's, because that's typically the case where you've got your implied higher than a star.
Yeah, but you do get environments where realized moves, we're in an environment right now. If you look at the broad market, most of the volatility measures are in the teens, and, realized volatility is in mid-single digits.
Agreed. And that spread is quite wide historically.
Yeah, and those trades have worked. Now, realize that's not always going to be the case, and that's why you enter into a spread, because, if you enter into a spread, if it's a $5 spread or it's a $10 spread, especially if you're doing European indexes, then that's your maximum risk. And if you do get a market move, you can adjust, you can roll down, you can roll up, depending on what your trade is. Sometimes you can just, simply close the position and say, look, I'll re-enter at a later date. But risk management is everything. And if you're doing some type of harvesting trade, I always tell people, don't look only at the rate of return, but have a real good sense of what happens if this trade doesn't work. What happens if you get a market event? And also tell investors, have a plan for what you're going to do. You sell something for $1 on a $10 wide instrument. You say to yourself, look, that's 10%. Expiration's 29 days away. People's eyes start to roll and say, well, God, to annualize, it's a fabulous rate of return. You go, slow down. slow down, because it isn't always going to work that way, and you need to have a plan of what you're going to do and how you're going to do it. In the early days of the SIBO, when as I mentioned earlier, the S&P 100 was the instrument of choice. You had people running around quoting, fabulous rates of returns, earning, double digits every week, and you kind of look at them and you kind of, you want to slap them upside the head and say, relax for a minute. What's your plan? How are you going to manage risk? And, some customers go into denial. And
then lo and behold, you get October 19th, 1987, and, everybody gets a real fast education and an absolute disaster in their pocketbook.
Yeah, and the biggest lesson you learn out of an 87 is scaling your trade size. Because what you saw at times like that is, customers would start in 86 and they'd sell 5, out of the money strangles. And then they'd make money for 3 or 4 months and they'd sell 10. And then they'd make money for 3 or 4 months and they'd sell 20. And you'd run into clients like that and you'd say, do you have a plan for when it doesn't work? It's always going to work. I can adjust these. What you had in 87 was a gap. And you had customers who a year before were selling 5 who now had 100 positions on, and the blotter went back to 0. So
overnight.
There's an issue of risk management. There's an issue of scaling the size of your trade. If you're comfortable with $5,000 worth of risk or $10,000 worth of risk, just because you had 4 months where you've made a handsome return, don't start increasing the risk just because it's worked. And risk management is everything, and that's why spreading is just so critical.
No question about it. Well, Alex, it's wonderful advice. There's a reason why you've been, at this game of education, predating the industry itself. So before we finish up, I guess I maybe just to change it up a little bit. Do you have a favorite story, about the industry, or somebody you came upon that you'd like to share with our listeners before we say goodbye?
So there was a story in the Journal last week about a hedge fund that had about a $700 million position in the stock, and the stock lost 70% of its value over the period that they held it.
That day.
Yeah. Okay. And the hedge fund actually reported an $800 million gain. They actually made more money over the time they held the stock and watched it literally, fall in price, because they were hedging, they were collaring, they were selling premium against it. And I think the story that resonates there is, to a lot of investors, when they buy the stock and the stock goes down, it becomes what we call a living dead position. They kind of stop looking at it. They go into psychological denial. And the reality is the options market gives you so many choices, so many opportunities. You can do trades that lower break even, that bring in premium income, that take out downside, that they took what to many of us would have been a dismal, I don't want to look at it, losing trade, and turned an $800 million profit. The profit was actually bigger than the original cost of the position.
Remarkable. But to your point, it speaks to the versatility of this wonderful financial product, the listed options space. And Alex, thanks for sharing your knowledge with us today.
Thanks, Joe.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Now it's time for Profiles and Perspectives. Joining me today is Mark Longo, founder of the Options Insider Network. Hey, Mark, thanks a lot for joining us today.
Joe, thanks for having me on the show today. It's a pleasure to join you.
Well, it's great to have you. Now, you've been in this options business for quite a long time. How did you get in this crazy business?
Well, like a lot of people, I got in the business in the mid to late 90s, back when the middle of the dot-com boom and everyone was looking for a way to enter the markets. I had an advantage. I took some college courses very early on in derivatives, and that kind of opened my eyes to the different things you could do with this product versus, let's say, stock or bonds or some of the traditional entry points people usually have when coming into finance. So I graduated college pretty much knowing already I wanted to get into derivatives in some way, shape, or form. I went down to Manhattan like most finance grads do at that time, looked around for a little bit, quickly realized in the mid-90s or so, the opportunities for derivatives trading in New York were relatively few. And then I got recruited to a market-making firm out here in Chicago, got brought out to Chicago, and I've been out here pretty much ever since. And the market-making track is really the track that most people took to get into this business, on the trading side anyway, until very recently. It was you came typically to Chicago. There were a few other places. I know, Joe, you were out in Philly. There was the P-Coast. There was Amex. There were a few other places where you could go to trade options. But really, the mecca for the options universe was out here on the CBOE. So I came out here and became a market maker. You do the typical point of entry for that position, which is you come out here to the exchange, you have a firm sponsor you and essentially train you for the better part of a year until they're willing and able to actually put up the capital for you and feel you're ready to go on a badge. Then they will sponsor you to take the exchange test, and then from there you're off to the races. You're off in trading. And for me, as I'm sure it was for you, Joe, the market making training route is really, I lament in many ways that lifestyle is going away. But I think for retail, the real sad portion of that is that market making and the training that goes into market making is really the best way to learn risk management from an options perspective. Because think about what the market maker does on a day-to-day basis. You walk down to the trading floor, or these days you do the electronic version of that, and essentially you have positions coming at you from all sides all day long. And you're constantly making markets and looking at risk and analyzing risk. And none of these positions are essentially prop positions. You're not going out there and putting on the position that you actually want. You're taking the position, the other side of the position that the customer doesn't want. So taking those continually over and over again and being able to spread that risk off and learn how that risk impacts you, let's say in an up 5 or 10% environment, down 10% environment, how it happens when vol moves, what happens when the weekend comes and you roll through the weekend, all these little things, as you become more nuanced and understanding of them, it really truly is the best way to understand options and to learn options risk management. And so that's why we always try to impart that wisdom whenever we can here at the Options Insider and through all of our different Options Insider Radio Network programs to try to give retail some taste of that, because unfortunately that lifestyle is going away. That profession is dwindling. And so the ways for retail to glean some of that knowledge and learn that are going away. So we're trying to approximate some of that, at least for the retail listener. And of course, as you mentioned, I've since segued into the online content realm. We launched the Options Insider, which is one of the leading online options destinations. That was a little over 6 years ago now. Kind of hard to believe.
6 years.
Yeah. At the time when we launched, we were really the first kind of free ad-supported online options content site. I mean, there obviously was the OIC doing free content before us. There was the SIBO doing free content before us. But your models were a little bit different. They were industry supported or supported by other things. For us, the content was and is the only model we have. We're out there putting out great content, and we went out and around to the industry and said, hey, you guys should support this. This is a good thing for you. And so far, it's worked very well. We've grown quite a bit. We, of course, have the Options Insider Radio Network, upon which many of you are listening to this right now. And that was at the time when we launched that in January of 2007. If it wasn't the first options podcast, it was pretty much one of the first. And I haven't looked at the detailed specs to see what else was out there at the time, but there wasn't much. I know OIC, you guys were starting to do some podcast stuff around the same time, but that was really about it. The options podcast landscape was as barren as anything. So we were really very early movers in a lot of different aspects of the options realm, and it's been great. It's been 6 years later. We're still, not only are we around and kicking, but we've grown quite a bit. We have a pretty large team now, distributed all over the country. It's the nice thing about being an online entity. We can have people working for us all over the country doing a variety of different things. And we also have the radio, which has kind of become unique to us. We built that one show into a network targeted at a variety of different options users of all stripes and all shapes and sizes. So if you're a basic retail guy, we have a show for you. If you're an advanced retail guy, we have a show for you. If you're a vol trader, if you're a futures options trader, if you're a financial advisor, I don't care what the demographic or what the product is you're interested in. We probably have something in the network there. And if we don't, it's coming very soon. So it's been a fun ride from market maker to online media, I suppose you can say it, online media firm entrepreneur. But it's been a very fun one nonetheless.
Well, that's quite a unique transition. I mean, what was the thinking behind leaving the floor and starting an educational network? It's quite unique.
The genesis of it was somewhat, I think you could say, haphazard at best. It wasn't my plan. It wasn't my plan at the time. I was still trading like a lot of market makers. I saw.
So make something up for me. Come on now.
Like a lot of market makers towards the late 90s into the early 2000s, I started to see the writing on the wall that this wasn't exactly a long-term proposition. The spreads were tightening. The day trading was starting to go away. You're getting a lot of one-sided paper, which really is a deadly detriment thing to a lot of market makers. And also, we were getting taxed to death. You're talking 40 cents a contract and more for some of these firms to buy order flow to your paper and to your pit, which doesn't sound like a lot on the surface of it, but if you're doing thousands of contracts a day, that becomes a significant expense you have to overcome on a daily basis. So all of these things were conspiring to work against the market maker. And so I started to transition more upstairs. And at the time, this is probably, I don't know, maybe 02, 03, I got contacted by some people I knew out in New York who were on the equity publishing side of the fence. And they said, hey, you're an options guy. We're primarily an equity house. We write mostly about equities, but we're looking to get into these options things. And we know you understand them. And they had seen, I'm not sure how they really knew, but I had interacted with these guys a little bit, so they knew I could at least put a sentence or two together, which from a trading mindset is a relatively distinct skill set. I've learned over the years building a contributor network of our own and working with a lot of great traders. And people who can trade are legion. The people who can trade and express themselves about trading, that's a much smaller subset of that. And so I started working with them as an advisory capacity on the side, just to help them learn about options and how they worked. And that led to me doing a regular monthly column with Traders Magazine and a few other publications about the options business and how it worked in the options industry. And that was just a fun side project for me, really. And then as the years came by, 03, 04 started rolling on, and I started to get a lot of calls from people saying, hey, we like what you're doing here. Can you do this for our publication? Can you do that for our publication? And pretty soon, I was inundated with requests to do content that was options-based content, and at the same time, market making was clearly dwindling. And so I said, wow, this is a surprise. I had no intention of really pursuing this. What are some of the ways that I could make an options content business work to offset some of my trading? And so at the time around 04, maybe 05, I looked into syndicating my columns in the newspapers, quickly realized that was a dying medium and there was no money to be made in that whatsoever. And then I started in 06, I came around the idea of making a website that was something like the Options Insider, where I could bring not just myself, because I knew there was no way I could provide enough content for all of the readers I wanted to have, but also build a contributor network of other people like myself, people who have a background in the options space, whether they're traders, market makers, brokers, exchange officials, what have you. They bring some insight into the space that you don't have when you just assign someone to write about options. I mean, it would have been a lot cheaper and easier for me to go out and hire a staff of English majors right out of college and say, okay, you're now my options staff, write about options. But I think the level of insight you get from that is pretty minimal. So we spent the time here at Insider really building our contributor network, and now we have a pretty broad and wide network of contributors from across the options business who write about all aspects of it for us. And that was kind of by design. We knew we wanted to be able to provide the insight, and that's really where the name comes from. The Options Insider name really doesn't refer to much inside information as it does the insight that these insiders can provide into the business. And so that was kind of where we kind of set ourselves apart from the beginning.
Let me ask you this. So you've got radio programs and content posted to your site. Is that how it works?
That's how it works, yes. You can also find our stuff, all your major online audio outlets, so iTunes, Stitcher, TuneIn, what have you. We're available all over the place. And
how many programs do you produce a week?
It depends on the week. I mean, we have different shows on different schedules. We have some new daily shows we just launched. We do, I'd say, I don't know, I have to look at the numbers, but every month we do. I looked at. This might be a better number for you to present to your listeners. I looked at the numbers for February recently, and we pushed nearly 100,000 hours of options content to our listeners in February. So yeah, it's amazing, And that's not all unique hours. That's a number of shows being downloaded over and over again. But still, most of our shows are an hour in length. So if we're doing anywhere near 100,000 downloads, that's 100,000 hours of content people are going out and actively downloading and listening to. And when we first started doing this, when we were really one of the first and only shows out there talking about options for any length of time online, it was anyone's guess whether there was an audience for this. I wasn't sure if I was talking to myself in our office there. I was like, who really is interested in an hour of derivatives content, hardcore derivatives content online on a regular weekly, daily, monthly basis? I had no idea, because I thought there was a reason no one was doing it, maybe because people had tried it and it had failed. But sure enough, 6 years later, we have, we're pushing 100,000 hours or close to it a month. And it's amazing to see what people are listening to and learning about, and the demand, and how I think, particularly for your audience and your perspective, Joe, at the OIC, the fascinating thing to me has been the growth and the evolution of that high end of the retail audience. Traditionally, if you had told me when we launched Insider 6 years ago, if you had asked me, what's the demarcation between retail and institutional, it would have been very clear and very stark. Retail does X size, they use these basic kind of strategies, and that's kind of about it. Institutional, much larger size, much more sophisticated, blah, 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 blah. That line, that demarcation has very much blurred over the past 5 or 6 years. I like to think we maybe had some small role in it here at Insider. I know you guys at OIC had a very big role in it. You guys are putting a lot of great content out there as well. A lot of other sites have put out free education, and it just, the universe and ways to learn about options has grown and expanded dramatically. We also have the brokerage firms really providing what can only be described as professional level tools for free to their customers these days, which is ridiculous. I don't know, Joe, when you left the floor, but when I walked on the floor, when we first started using handhelds on the SIBO, this is probably maybe 98, 99, it was like voodoo. And when I had a handheld that was updating my theta and my gamma and my vol, and all the guys around me were standing there with sheets, they thought I was some sort of witch doctor. So they would say, oh, you're getting your stuff set from upstairs, and there's all kinds of, crazy things said about that because they didn't understand it. And now fast forward, 10 years or so, and those tools are not only widely available, they're available for free to anyone who has a retail brokerage account. That is amazing. They could track their gamma, they could look at their volatility skews. If you had told me retail would even know what a vol skew was 5 or 10 years ago, I would have said you're crazy. So, the landscape has really changed. The launch of products like VIX has really opened the eyes of retail to what some of the other asset classes are available out there. It's really just been a very, very interesting evolution of that. And to me, that's where a lot of the interest is now. These retail are coming to us now and saying we want to learn about commodity options. We want to learn about volatility products. We want to learn about, how I should pick a financial advisor who knows about options, and all these various and nuanced things that were not even the domain of retail 5+ years ago are now suddenly on the horizon. And so that makes it very interesting for us because we cater to a wide variety of audiences at Options Insider, not just retail, also institutional, also financial advisor. But retail is a good core audience for us, particularly that very high end of the retail spectrum. And to see them evolving in their demands and in their needs is really fascinating to me. I think a great example, too, is we do all of the audio with you guys at OIC for your Options Industry Conference every year. And if you had told me who the audience would be for, let's say, a credit default swap OTC clearing panel you guys might do at OIC, I would say that's the very hardest of the hardcore. Those are people who are in the business. Maybe a couple hundred, maybe a couple thousand people would download that. But we'll take that audio, we'll record it, we'll put it out to iTunes and other venues that are traditionally retail heavy, and we'll see thousands of downloads going into that show, and it'll last for years. People will go in years after the fact and go and download, let's say, the OIC credit default swap clearing panel from 2 years ago. And it amazes me, and that is predominantly retail coming in through iTunes. So the level of interest, the level of knowledge, the skill set that has arisen in the retail spectrum has really just been fascinating. And to me, that's pretty much the defining story of the options market over the past 5 or so years.
Yeah, the growth has been really extraordinary. I know the gang here at the OIC, we're very pleased to have you produce and distribute, Wide World of Options, and look forward to a lot of fun together, getting education out to the public.
I said we're looking forward to this. It should be fun.
Couple quick things. I know, you've got a wide reach. Other initiatives that you're working on in the industry outside of just the network?
Well, it's funny you should mention that. We have a lot of interesting things in the hopper right now. I mentioned, for example, we're a completely free and open destination. All of our website stuff is free. All of our online radio is free. We're also looking to expand on the video front. A lot of people are doing different aspects of options video. We've been slow to go into that realm for a couple of reasons. First off, we're known for audio. Audio has kind of become our bailiwick. People come to us looking for shows and looking to produce shows with us. It really is a niche unto ourselves, and so we like that. We like being a unique destination for that. When you dive into video, if you don't do it in the right way, you can kind of just be another Me Too video person. So we're exploring different ways to embrace video here at Options Insider. What I don't want to do is become, let's say, the Imus in the Morning of the options space, where we just film our radio shows. I don't know how compelling video a radio show really makes for. I don't think it's that fun to watch. So we're looking at interesting ways to do that. The other challenge we have here at the Options Insider is we like to embrace deep, complex content that can take an hour to discuss. An hour of a video is a different story. Video usually is maybe 5, maybe 10 minutes if you really do a long one. So we're looking at different models, different subjects, different ways to tackle video in an interesting way that will be interesting for our listeners, for our readers, and for all the partners who work within the industry. So we're trying a number of different approaches on that front, and we haven't exactly nailed it down yet. But that'll probably be the next big initiative coming from us, in addition to a lot of new, shorter form email content from us. We do a lot of the big newsletter every week, but people have always asked for a lot of shorter form stuff from us, so we're looking to put together. We're doing a new daily radio show, the Options News Rundown, which is a list of the top headlines from the options market. We'll start seeing some of that stuff in email as well, with email alerts, email rundowns of the top option stories, the top unusual activity, so people can come to our site and really add a lot of great stuff that way. You know, we had an expanded focus on mobile as well. If you've been to our site anytime in the last few months, you'll see that we've revamped it all with HTML5, so that makes the whole site perfectly formatted for any mobile device you should be using. So if you come to us via, whatever it is, an Android, BlackBerry, iOS, it'll format nicely on your tablet or on your phone. And we're also looking to take that even further with a dedicated mobile application. We're trying to figure out what would be an interesting hook for a mobile application that you can't just get on the site right now. So we're working on that as well. But mobile, certainly an important focus for us in 2013 as well. So a lot of great stuff. I think the Options Insider brand is really going to expand into the in-person conference and event space in 2013 and beyond. So look forward to that. A lot of great stuff coming from the Options Insider this year.
And Mark, what is the web address, for our listeners?
Well, you can find our website at www.theoptionsinsider.com. Don't forget the THE in front of it. If you don't use that, you get who knows what you get. But use theoptionsinsider.com. Of course, you can search for Options Insider or Options Insider Radio in iTunes or Stitcher or TuneIn or whatever your audio provider of choice is, and you can find all of our programming there as well, including, hopefully, this show very soon once we launch the wide world of options.
Amen to that. Well, Mark, really appreciate having you on today. Thanks very much.
Thank you, Joe.
It's time for a nostalgia break. It's time to take a look back.
Now it's time for our Looking Back segment. Picking up on where we left off last week, going back to 1977, the SEC placed a moratorium on additional listings in the options industry, pending a review of what now at that point was a rapidly growing industry. After close to 3 years, the SEC lifted that moratorium in 1980. In 1982, the options disclosure document, also known as Characteristics and Risks of Standardized Options, was created. And now going back to the stock market, also in 1982, it was August of 82 that the Dow bottomed again at that 777 level. Finally, in 82, the options volume on a daily basis exceeded 500,000 contracts a day. And that's our Looking Back segment for today.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
Our final segment today, Tools, Resources, and Good Reads, includes, an old, I guess you could call it an indicator. It was, to me, just really an alarm bell that I'd look at, and that would be the average 20-day option volume. I'd have my half dozen favorite underlying stocks, and I would know what the average daily volume for all the options combined were on that underlying and take the 20-day average. So let's say we got XYZ, and on average, it would trade 5,000 contracts a day. I'd have just my own personal filter. It was really more art than science, where I'd be looking for a multiple of 3 times that average daily volume to give me, up as to when, something really unusual in the space was going on. So if we average 5,000 contracts a day, I'd be looking for in excess of a day where 15,000 or more contracts traded. And that really, for me, was a filter on the whole market of optionable stocks, not so much just, those stocks that I was most familiar with, because those stocks certainly I'd have a good idea of the options order flow. So that multiple of 3 times the 20-day average daily volume is something that, I used to look for as an idea generator. Something going on in the options market that was unusual. I would then go in, look at the underlying chart, begin to look at the implied volatilities, and decide whether that was an underlying maybe I wanted to put a position on it. And lastly, today, I'd like to add Larry McMillan, that author of the famous options book, Options as a Strategic Investment, to our list of good reads. I guess that wraps up our show today. Thanks for joining us this week, and I hope you'll tune in next time for more strategies, interviews, and resources for you, the investor. Until then, thanks for listening, and we'll see you next time on OIC's Wide World of Options.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.